For WorldatWork and WorkSpan TV, I'm Ryan Johnson. I'm joined in the studio today by the CEO of Equilar, David Chun. So the topic today, David, is executive compensation trends for 2011, and I know you've got some new data at Equilar. Why don't you just start with the maybe the biggest headline out of the proxy season?
There's been a number of headlines this most recent proxy season, but in particular, the last couple of years we had pay certainly moderating. Pay was actually saw 2 years of consecutive declines. We have seen a tremendous recovery in CEO pay this year. CEO pay is at an all-time high for large cap CEOs, hitting $9 million. And that's up about 28% versus last year's CEO pay figure. So overall, and basically across all pay elements, we've seen increases, whether it's bonuses, long-term incentives, and it's been a good year to be a CEO.
Well, how does it comport or not comport with earnings or with profitability of companies?
The good news is that we've seen a very strong alignment with how well companies have performed and the incentives that CEOs have been rewarded for the success of the companies. And in particular, so if you look at some of the key metrics, total shareholder return actually for calendar year 2010 was virtually flat. I think it was down about 2%. Revenues were actually up about 9%. So the economic recovery, we saw that continue into 2010 and saw companies continue to expand their businesses. The most impressive metric, if you look at company performance for 2010, is profitability of the businesses. And profits were up about 44% versus the prior year. Another interesting statistic to take a look at is how does that look on a per employee basis? And this is, as we're seeing with the unemployment figures that are published, and while companies are performing better, unemployment remains somewhat stubbornly high, close to whether 8, 9, 10%, depending on what part of the country you're in. And profit per employee was up 50% for about $26,000 per employee in 2009 to $39,000 in 2010. So what you're seeing here is that companies are actually doing more with less, and I think many of us are feeling that, seeing that hey, companies are asking their employees to work harder and they're producing. As a result, the benefits, certainly more has probably trickled up to the CEO, but we're seeing companies certainly outperforming in this coming out of the most recent recession.
So I think what I heard you say is that there is pay for performance in the executive suite.
If you're looking at those metrics, revenues, profitability, profits per employee, clearly you're seeing alignment there with how well pay packages have been designed. Despite
the stubbornly high unemployment and some melees among the general working population.
Exactly. And what you're seeing, though, is that we've had that, the jobless recovery of 2010. I'm up in Northern California in Silicon Valley. The hiring up there, especially with certain employee classes, I mean, they're off the charts.
What's happening with long-term incentive grants?
Yeah, it's interesting. If you look back on long-term incentives last decade or so, and pretty much the only long-term incentive you saw out there were stock options. That has clearly changed almost 180 degrees in the opposite direction. And a big driver of the success of companies, of CEO pay packages in terms of the increase here, have been stock awards, and whether that's time-vested stock or performance shares. Options are also up, but not nearly as large, and you're seeing more and more companies moving away from options. I think what's possibly driving that is the proxy rating agencies out there looking for more performance-based pay, and frankly, in most companies, the rating agencies are not giving credit to the companies for granting options, even though options clearly are, the stock price has to go up for these to be of value, but if they don't have additional performance criteria associated with the granting of the options, the rating agencies are not giving them credit. You're seeing more companies moving towards whether it's some performance-based share award on that front.
So you mentioned the proxy rating agencies. Let's talk a little bit about, of course, the big issue in the last year or so has been the say on pay issue.
Sure.
And it's quite a buzz both in the WorldatWork magazine and in a lot of other of the compensation literature. What are you seeing in terms of say on pay?
Two major issues around say on pay. One being say when on pay, how frequently companies should put this out to a vote. We saw many companies hoping to go out with a triennial voting every 3 years. However, the institutional investor community quickly got their point across saying, hey, we'd like to review this every year. So despite many companies trying to go every 3 years, we're seeing many companies being requested by their shareholders to do this on an annual basis. But then with regards to the pay packages, the voting trends, you would think in a year where pay was up 28%, Despite, while there's been very strong performance of companies, we haven't seen pay up that year-over-year increase in at least in the 11 years we've been tracking pay at Equilar. So you would think there'd be greater resistance from the institutional investor community with regards to approving pay packages, but frankly, early voting results that we've seen so far, over 75% have given companies 9% have been in favor of what companies are doing with regards to pay practices. There's clearly been discussions, I'm sure, behind the scenes with issuers, with their institutional investors about what they would, what the institutional investor would like to see with regards to changes that they would like to see with regards to pay practices. So you're seeing companies eliminating gross ups, cutting back on perquisites, implementing clawbacks, anti-hedging provisions. So your checklist, your laundry list of good governance practices, you're seeing many companies adopting that. And so it's been frankly a relatively benign proxy season when you see that over 75% have received at least 90% in favor of their votes.
Well, Dave, a great summary of the executive compensation trends in 2011. I want to thank you for coming in. It's been David Chun, CEO of Equilar, and for WorldatWork and WorkSpan TV, I'm Ryan Johnson.